an absolute quantitative minimum, using models to identify whether and where higher than those minimum capital requirements were appropriate. And I suspect that that is where we should and will migrate over time. So considerable progress, but much remaining to do. But I am confident that we will get there and that we are on the path to building over the medium term a far sounder financial system. But the challenge is not simply to build a better system for the medium or long term, but also to transition to it while not harming the recovery from the Great Recession, which the crisis of 2008 induced. And I think the startling feature of the last 3 years, has been that that transition has proved far more difficult than we thought. If we look at pretty much every official forecast which was produced in early 2009, it understated the scale and the longevity of this recession. And that reflects, I believe, our failure to understand just how powerful are the deflationary effects created by deleveraging in the aftermath of a financial crisis. When credit booms turn to bust, as we should have known from Japan throughout the 1990s, private sector deleveraging can have powerful deflationary effects, and all our conventional policy levers tend to lose powers. Interest rates move to the zero bound. Quantitative easing is appropriate, but may face diminishing returns in a liquidity trap. And macroprudential levers are stymied by a don't start from here problem. We actually haven't got the capital buffers in place, which we ought to have built up in the boom years. We don't have them there, and therefore we don't have the ability to get rid of them. Faced with a recession, meanwhile, public sector finances deteriorate, and so for a long period of time, and certainly for the last 4 years, deleveraging doesn't actually produce a reduction in total leverage. The best we achieve is that for every percentage point decline in private sector leverage, our public sector leverage increases by the same amount. Together, this creates an extremely challenging environment in which, as the latest World Economic Outlook puts it, the risks of recession in advanced economies are alarmingly high. And in that environment, there is a danger that progress towards where we need to be in the long term could further depress nominal demand and activity in the short. If we increase capital ratio requirements and leave it entirely to private banks to decide when and how to achieve those higher ratios, we may simply provoke further deleveraging and deficient lending supply. So we do face, I think, a bit of a trade-off between the progress to where we need to be in the medium term and the short-term effects. What can we do about it? In conclusion, there are two possibilities. They are not mutually exclusive. The one is to combine progress towards a sounder financial system with innovative, unconventional policies which seek to cut through the challenges of our impaired financial system, and either, as Olivier Blanchard put it in his WEO Forward, to help particular categories of borrowers or to help financial intermediation in general. And the UK, over this summer, introduced such a package of measures which included additional central bank liquidity insurance and a matching adjustment to FSA liquidity requirements to allow some credit for that insurance. It involved direct central bank funding support at an attractive rate for bank lending to the real economy, and it involved some adjustments to the FSA's capital regime, essentially to allow the use of existing buffers above the legal minimum to support the new lending rather than imposing additional incremental capital buffers. So that's one possibility. We offset this trade-off problem by a set of unconventional measures to help overcome the financial intermediation problem. The second is to cut through the balance sheet resilience lending supply trade-off by engineering rapid increases in bank capital resources. Effectively, this would mean a repeat of the 2009 US approach. That required banks to conduct robust stress tests. It defined quantities of absolute dollar capital, which each of the banks were then required to raise, and it provided a public backstop if banks were unable to raise new capital from private sources within a prescribed time period. In principle, such an approach clearly has an attraction as a way of resolving this tension between medium-term direction and short-term deleveraging effects. In the Eurozone, however, it could only be credible if the public backstop were available at federal Eurozone level, applied at a national level within the more vulnerable periphery economies, it would simply strengthen yet further the potentially fatal sovereign solvency, bank solvency embrace, which is at the core of current stress. So clearly, there are no easy answers here. The challenges created by deleveraging in the wake of an excess credit and leverage boom are very severe. That tells us that we've got to make sure we absolutely don't have that problem in the future, and we need to be robust in the pursuit of a much sounder, lower leverage system in the medium term. But it also means that we've got to find ways to navigate through the headwinds created by deleveraging in terms of economic growth. Thank you very much.
Good afternoon, everybody. I'm very honored to be asked to speak here, though I must admit to some trepidation like a modern-day Daniel, given my role. The crisis did reveal weaknesses and failures in bank behavior, for sure, policy and regulation globally, creating political, economic, and social turmoil. We have had and continue to need real leadership to move forward and to instill confidence in the market to ensure that at least this same set of items don't repeat themselves. A great deal of that leadership has been driven by regulatory bodies in the form of financial reforms. The industry is united in its commitment to the G20 principles behind the many regulatory initiatives. The public sector should not have to assume fiscal liabilities in order to rescue banks in the future. However, whilst the goal must be to ensure financial stability and growth, we have to preserve open, liquid, and efficient markets. Efficient markets allocate risk capital and intermediate credit. Both are necessary for growth and innovation. A regulatory framework ought to be capable of ensuring stability without restraining economic growth. It is inevitable that policy and regulation will fail to keep pace with change and innovation, necessitating significant revisions to rules. The complex problems we face require a delicate balancing of somewhat conflicting political, economic, financial, innovative, entrepreneurial, and social interests, or despite our best intentions, many financial reform efforts could result in unintended consequences. I will briefly touch on 4 examples of such. One would be the large exposure regime known as the single counterparty credit 165E. It makes complete sense to limit single counterparty concentration risk, but the calculation and difference of bases on that is causing confusion. Credit risk retention is another example of the securitization markets. It makes complete sense to try to align incentives in the securitization markets by requiring securitizers to retain an economic interest in the credit risk of assets that they securitize. But the associated capital and balance sheet requirements could severely hinder the provision of credit to society. Another one would be the derivative clearing mandate. It makes complete sense to reduce systemic risk. But issues relating to daily marking, risk mutualization, a proliferation of asset and regional-based clearinghouses, and a lack of fungibility across platforms could create different but significant systemic risks. And also you could say the same for the margin for uncleared swaps, which again makes complete sense, but you could have a potential drain of huge size from the market on contracts that would be eligible for clearing. I want to quickly highlight 5 issues. Some have been touched on. The narrow focus of regulations on specific problems. All regulation should be proportionate and clear. Regulatory frameworks must complement and not contradict, or rules become difficult to comply with and to enforce. In order for regulation to strike a global balance, regulators must work with each other to agree on the problem they are attempting to address, identify potential approaches, ensure that the proposed regulation, if in place, would have an appropriate mitigating effect, and work towards common goals attempting to minimize regulatory arbitrage, create level playing fields, minimize complexity, balance burden and benefit, and harmonize adoption and compliance timetables. The second, regulatory coordination. International cooperation, and if I may also say so, domestic cooperation in some cases between regulators is essential to promote consistent and complementary frameworks. The interconnected nature of the regional and global capital markets must be a central focus. The cumulative impact of regulations within and across jurisdictions must continue to be factored into the regulatory process itself. Overlapping and multiple regulation creates potential for conflicts and makes it more difficult for market participants to understand having impact on the market. One example, in Europe alone, there are 3 different sets of suggestions on how to restructure banks in Europe: the Liikanen Group proposal, the UK Vickers report, and the implication of the Volcker rule. As a US bank whose international operations are headquartered in London, we may very well be subject to all 3. Regulatory proposals intended to decrease risks and exposures could shrink the capital markets, with unintended consequences to liquidity and credit creation. One example would be the overlay of the Basel liquidity coverage ratio, and the increased margin requirements for derivatives could lock up an estimated $5 trillion of liquidity in the financial system. These liquidity constraints could be exacerbated by other reforms like the large exposure regime as discussed in Volcker. We do appreciate the work focused on quantifying potential demand for collateral by the FSB and potentially emergent risks. Simply harmonizing definitions as well as adoption and compliance timetables will significantly ease cross-border implementation burdens. Now, there are successful examples of global regulatory harmonization. Margin standards for uncleared trades. The early proposed US rules acted as a catalyst for global concern about how US standards would impact dealers and counterparties globally. Basel and IOSCO harmonizations have helped. There's still a lot of work to be done. On single counterparty credit limits, the large exposure regime, proposed US rules and calculation methodology differed from the CRD4 standards. We understand now that an international working group is being formed. Again, such efforts are welcome. Global markets like foreign exchange and credit need convergent frameworks. Regulators working together through colleges and organizations like IOSCO, FSB, etc., will help in promoting that global consistency. On the CFT cross-border guidance, greater regulatory coordination would have significant benefits. We've had some good news there again today, but the global markets need a framework to determine which rules apply to which parties and which transactions. The extraterritorial application of such rules may complicate hedging arrangements for non-US clients and indeed lead to a friction within dealer marking, which is happening already. Coordination on fundamental definitions will help the marketplace. The third issue, volume, complexity, and challenges of global regulation. We support the broad path of regulatory reform. However, the volume and complexity of rulemaking globally is somewhat overwhelming and increasingly more complex, which leads to increased burdens for all market participants, including regulators, investors, and supervisors. There's a lack of clarity and consistency in the market. And I do agree with what the governor said earlier, although I hope not to misquote him. These problems are not new. It's just the way you deal with them is the framework you look for. A byproduct of all of this is the estimated cost of regulatory reform. No one knows with certainty what the cost will be. The IMF estimated last month, September, that commercial bank lending rates would increase by 28 basis points in the US, 17 basis points in Europe, 8 basis points in Japan. The IIF provided estimates that were significantly and multiples of that. In 2010, the US House Financial Services Committee estimated the cost of Dodd-Frank related legislation and rulemaking would be around $1.25 billion in the fiscal year 2012 for the US government alone. A European think tank thinks across the industry the range of EU reforms could cost 50 billion euros. It is not possible or desirable to seek to establish a discrete set of rules designed to cover all future eventualities. The industry needs to continually innovate, remain dynamic and responsive to changes in client needs and market structure. Regulation will need to be as responsive and dynamic. The FSA's new judgment-led approach to supervision especially recognizes this. As we utilize technology to establish new platforms and venues for trading and settlement, we will need regulatory frameworks that create incentives to provide greater liquidity at reduced costs while effectively managing the operational complexities and potential risk of faster execution. And finally, touching on shadow banking, a huge amount of work has been done in this area by Lord Turner. But the term shadow banking connotes something negative and very dark. Non-bank system is a better term. In reality, transmission of credit has never been solely the preserve of regulated banks. Other sources of finance and credit intermediation have existed for some time. A plurality of capital raising and credit intermediation opportunities must be beneficial for the market and the public, especially as banks in Europe continue to delever. We think two themes are important here. In principle, regulation should establish a level playing field for businesses that compete with each other. However, this does not mean that the rules have to be exactly the same. It is the outcomes that are important. Nevertheless, it is important for the risk posed by the non-bank system to be carefully analyzed on the basis of clear evidence, which the FSB is doing in its work. It is right, however, that risk should not merely shift outside the regulated spectre. So in conclusion, to support economic recovery, we must strike a balance between growth, innovation, regulatory guidance, and control. This September in the UK, the FSA, Treasury, and Bank of England, in an effort to boost growth, readjusted the liquidity requirements imposed on UK commercial banks to ensure that lending to businesses and consumers was not unduly hindered. We think the general direction of the G20 agenda is clear, and that most governments in the US, Europe, and Asia are continuing to implement it regardless of political affiliation. We fully support that agenda. Any regulations that reduce systemic risk, create level playing fields, enhance the stability of the financial sector, and ensure that risk is efficiently priced can only be beneficial for investors, our clients. And I'm also aware that the one thing that the industry needs to do, in answer to Terry, is a wholesale cultural renovation, and I believe that that is undergoing at the moment. Thank you.
Thank you very much. I just rushed from the discussion of European issues in this building, and I will speak about the financial regulations from a little bit wider perspective because I'm in the Treasury at the Ministry of Finance, and I'm following macroeconomic issues usually. But there is a lot of interaction between the financial regulations and macroeconomic policies. So first, I would like to speak a little bit about this crisis. And it is obvious that this crisis has two root causes. One is macroeconomic imbalances, including kind of a very easy monetary policy based on the assumption that once the crisis happens, the monetary policy tightening can take care of the smooth, smooth transition to the ordinary situation from the bubble. So the idea was it was difficult to prevent the bubble happening, but once it burst, we can take care of it. But it was not really true. And also there was imbalances in current account between countries. Some countries have a very big surplus and others have a very large deficit. And it was not very sustainable. But at the same time, there was a reason in the financial sector, that is the financial innovations and so on, promote the very excessive risk-taking and leveraging, and the financial regulations was not up to the innovation and the activities of the financial sector. So it is obvious that we should once again strengthen the regulations. It is not just because of a crisis, but it is because of the cost of the crisis. I mean, if the taxpayers must take care of the financial system once it is bankrupt, or if taxpayers are asked to give a guarantee to banks, whether it is a deposit or the liability of banks to prevent the run to the banks, we really need it. But if taxpayers' monies are involved, of course there should be regulations by the government. Otherwise, the managers and the shareholders of banks can take advantage of a big pay bonus during the good time. And if something wrong happens, if it is a burden of taxpayers, it's not, from the efficient perspective, it's not good because it can repeat the crisis. It's not a good allocation of resources. But also it is against the idea of equity. So that's why the advanced economies, especially countries where the crisis happened, like in the United States or in the United Kingdom, there is a very strong momentum to strengthen the regulations. So this kind of the change of idea has been implemented not just by national authorities, but through the coordination of the governments through the G20. Head of states argue detailed discussion